Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we will look at the basics of multi-factor investing. The basic theory of multi-factor investing is pretty simple. It has been widely proven that individual investing factors like value and momentum can outperform the market over long periods of time, but no reward comes without risk. In this case, the risk is the significant periods of underperformance that the factors can endure. All the major factors have had periods as long as a decade that they have trailed the market. That is where multi-factor investing comes in. In theory, multi-factor investing offers investors an opportunity to blend these factors together to reduce risk and smooth out those bad periods. If a portfolio can have some value and some momentum and blend it with other factors like quality or low volatility, that can help to reduce both the length and magnitude of underperforming periods. It is similar to how a good sports team works. If you have enough good players, they will pick each other up when one player is having an off night. Research has shown that when constructed properly, multi-factor portfolios will limit both the length and depth of underperforming periods relative to the individual factors. Here are a few things to keep in mind when analyzing multi-factor strategies. The first is that multi-factor investing is not a panacea. One of the two major reasons factor investing works is because it is risky. Combining a bunch of factors together isn't going to change that, at least not completely. And in trying to change that, you have to be very careful that in that effort to reduce risk, you aren't also diluting the factor exposure you are trying to achieve. Turning a portfolio into an index you are attempting to beat in order to make it less volatile doesn't serve much of a purpose if outperformance is what you are seeking. So just like any other type of factor investing, your expectation going in should be that you'll have extended periods where you underperform. Those periods may be shorter and narrower than with individual factors, but they will still be there. The second is that which factors you use and how you combine them is important. Not all multi-factor portfolios use all the major factors. Most use value and momentum, but some stop there and others add additional factors. And once you select the factors, you then have the issue of how to combine them. There are two main ways to build multi-factor portfolios. I call the first one the sleeve method and the second the consensus method. The sleeve method just takes individual factor portfolios and combines them together. For example, if I wanted to build a 3-factor, 30-stock portfolio using value, momentum, and quality, I would just take the top 10 value stocks, 10 momentum stocks, and 10 high-quality stocks and combine them together. Supporters of this method think that it keeps the exposure to the factors in its purest form. Using this method, for example, the stocks selected with value would only be selected using value, and so they would be very cheap and have the most value exposure. The second method is the consensus method. The consensus method looks for stocks with high exposures to multiple factors. So, for example, if I was building a portfolio with value and momentum, I would look for stocks with some value and some momentum. This results in less pure factor exposures, but it allows an investor to select stocks that have multiple positive traits. As is the case with many things in investing, there likely is no correct answer here. So the point isn't that one approach is better. The key is to just understand that what you're getting is different between the two approaches. The final important point to keep in mind with multi-factor investing is that portfolio construction plays a major role. Which factors to use and how to combine them is only part of the equation. There are also decisions like how many stocks to include in the portfolio and how to weight them that can play a big role in both risk and return. Focused factor portfolios tend to perform better, but they also tend to be more volatile and will have more extended periods where they underperform and outperform. For investors who want a smoother ride, more diversified portfolios can work better, but you need to be careful that the portfolio isn't so diversified that it becomes the benchmark and loses its factor exposures. Position weighting within the portfolio is also a source of significant differences. Many portfolios are just equally weighted, but others can be weighted based on conviction, with the highest scoring stocks receiving the largest weights. Inverse volatility weighting is also becoming more prominent. The theory of inverse volatility weighting is that you want to weight each position in your portfolio so it contributes an equal amount of risk. The least volatile stocks get the largest weights, and the most volatile stocks get the lowest weights. This can serve to reduce volatility in a portfolio, but it can also cause its performance to be more tied to the performance of low volatility stocks in general. In the end, there is no perfect solution here. There is no optimal way to build a multi-factor portfolio. The right answer for one investor is likely different than the answer for another. It is important, though, that the techniques that are used to build a portfolio are thoughtful and have proven themselves over time. And as is the case with most things in investing, the most important thing is your conviction in the approach you select. Without that, even the most carefully constructed multi-factor portfolios will fail to deliver the results you desire. This concludes our look at multi-factor investing. We appreciate you taking the time to watch the video. To find more of our Validea University videos, you can follow our Validea channel on YouTube. You can also follow us on Twitter at @GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22+ factor models we run, you can go to our research website at www.validea.com. Thank you for watching.